In 2016, Citigroup fell to number 8. Okay? And the size of these banks have grown so much that in 2016, they were, the amounts are quoted in billions of dollars. All right? So Citigroup in 2016 had 1,801 billion in assets. Okay? The largest one now is ICBC, all right? And that ICBC, where you think that bank is located?
Maybe London? I don't know.
So guess what? And it just shows you how the world economy has changed. Things have flipped around significantly, all right? In your version, at number 16, we have Bank of China, all right?
Mm-hmm.
In 2016, and I believe up to today, Bank of China is number 2.
China.
Okay?
Bank of China.
It's called globalization. It's called the rise of China. Okay? And the number 1 bank is also in China. It's called ICBC. All right? And they have total assets of 3,420 billion US dollars. So you're talking about a market, an international banking market with banks that have assets of plenty money. Okay? And so this is why just the asset size, even without looking at the current information, if you're looking at the 2001 information, the asset size of these banks so large, it suggests to us if the asset size for these banks are so large, the billions of dollars that are passing through the banking system on a daily basis, all right? And because all of this money is passing through the banking system, hence the reason why regulation is paramount, okay? And so I want us to look a little closer at the regulation. And so the regulation, we're talking about the Basel Accord, all right? I want you to go on your devices to bis.org.
BIS.org.
So bis.org is the website, right? When you go to bis.org, you're going to find lots of information there. Okay? A lot of information. Now,
Okay.
what we want to focus on is what BIS has done to help these international banks to remain above board, to remain well capitalized, because they need to protect this many billions of dollars that's passing through them daily. Okay? So with the Basel Accord, you have, first you started with pure capital adequacy ratios, which was 8%, all right, just 8. And then that changed over time from Basel 1 all the way up to Basel 3, that would have changed, okay? So the 1988 Basel Accord, which is considered Basel 1, okay, it's actually called the 1988 Basel Capital Accord. It actually has that in the name, the Basel Capital Accord, okay? And so back then, it really focused just on deposits and lending, okay? And so the focus there was on credit risk, because it was felt that the banks were lending, the international banks were lending to these multinational corporations, and so they needed to ensure that they protect themselves from credit risk, all right? And so 1988, throughout the world, the Basel Accord was accepted. Now, when you talk about 8% of, when you talk about 8% of assets, all right, being put aside for capital, back in 1988, 8% of assets, it was sort of arbitrary. Who decides what assets you are using the 8% for? On a bank's balance sheet, there are different types of assets, right? What are they? On a bank's balance sheet, you have
securities,
you have cash, you have
inventory,
property, plant, equipment, loans, that's the major thing on a bank's balance sheet, loans and investment securities, right? So those are your assets. 8% of what? Is it 8% of your total assets? Is it 8% of your loan assets? Is it 8% of your investment assets? All right? So it was felt that Basel Accord was a bit weak, okay? And so in the 1990s, I think it was finally established in 1999, that Basel would have changed how you select the capital, okay? And so they didn't just look at the loans, they didn't just look at the lending, all right? They now looked at risk. What are you exposed to? So they looked at operational risk, okay? They looked at credit risk. And now they're looking at, now they also look at, as part of operational risk, they include technology, all right? So the 1999 Accord, you go to the readings, they included operational risk as well. And so what they did was to specify different, they had different tiers of capital. So you have tier 1, tier 2, tier 3. And that was separated into credit, operational, all right, technology, and so on. So what Basel, so Basel 1 was just a single accord, 8% of risk rated of capital, okay? Basel 2, they had 3 pillars that they worked from. And so you had your minimal capital requirements, then you had your supervisory review process, and also, so 3 pillars, the minimum capital, supervisory review process, and your risk-weighted assets. So you're looking at those, okay? So your capital, okay, initially was 8%. On everything, your market, your credits, your operational, but it didn't specify how much of each went to the 8%. In Basel II now, they added the other pillars. So you have where they looked at their internal processes to see what is the risk, and then there's other guidelines to help banks to define the risk, to measure the risk. Okay? So they look at those risks. Now, as time went on, banks were not able to, some banks rather, had problems maintaining the capital as risk-weighted capital. So it was there, they had the capital, but they were struggling. And so when you had the crisis, 2000, it really started in 2007, 7, 8, 9, you had the crisis because of the housing market had fallen, had crashed. Many banks had invested in the mortgage-backed securities market, all right? So the banks had a problem. Back in 2009, in the US in particular, and even in Europe, banks were bailed out, all right? And so Basel III came about to strengthen Basel II. You need to go do the reading. You need to go and do that reading. But you need to go to the website to do it. That's why I told you to look for bis.org. We're gonna go, I'm gonna go through that with you. All right? Now, so let's go to bis.org. And for those of you in 3076, this helps as well. I said it helps. Okay, so
Time for international settlement.
so to make your life easier, we're gonna look for Basel Accord.
Search.
Okay. So when you look for Basel Accord, when you just go in their search field and type Basel Accord, and you're going to get at the top your key result is going to be Basel III. You can't really see that, that's why you need to do it for yourself.
Basel III monitoring.
Basel III International Regulatory Framework for Banks. All right? And what they're showing you here is the summarized Basel III arrangements. Okay, so it tells you it's an internationally agreed set of measures developed by the Basel Committee on Banking Supervision in response to the financial crisis of 2007 to 2009. The measures aim to strengthen the regulation, supervision, and risk management of banks. And it goes into detail, all right, about what they are. So you have a summarized Basel III. So it talks about the transitional arrangements. You can go to the summary table, all right? And you can also get further information. It has explanatory notes. It tells you how you work out your risk-weighted capital and so on. It gives you some details there. So I'm just introducing you to the site because that is where you're going to get information on Basel 1, 2, and 3. If you go back, you will see the history of the Basel Committee. You're going to see Basel 2 on economic assessment. You're going to see Basel 2, the revised framework. All right, and then the Bank for International Settlement would have written several papers on this, and they would have done some research in terms of how are banks doing with these guidelines. Right, so have a look at that. Now, okay, I want to now bring your attention to, I'll have to use an example from this one.
We have 40 minutes left. Times have changed.
Okay, so in your version of the text, right? Example 6.1. You will notice in that example, all right, it says Teltrex International can borrow 3 million at LIBOR plus a lending margin of 0.75% per annum on a 3-month rollover basis from Barclays in London. Suppose that the 3-month LIBOR is currently 5 and 17.32.
141 in the book.
We're not using this example, I'm just pointing something out to you. So suppose that the 3-month LIBOR is 5.17.32. That's the rate. What does that mean? What does that mean to you? 5.17.32. I'm just pointing out to you that back then, rates were quoted, money market rates, even treasury bills and so on, were quoted in fractions. So what this means is 5 and 17.32. So 17 divided by 22 will give you what? Do it. 17 divided by 32.
0.5, around 0.5.
0. So this means 5.53%. Okay? They're no longer quoted like this. All right, so I don't want to use that as, I don't want to use the example. I'm going to use the same example, but not using the fraction, using the decimal, okay? And so it says, it goes on to say, suppose that over the second 3-month interval, LIBOR falls to 5 and 1/8%. So it falls to 5 and what? 1/8 is how much? What's 1/8? What's 1/8? 1 divided by
0.125.
right? So it falls to 0. How much will Teltrex pay in interest to Barclays over the 6-month period for the euro-dollar loan? How much will Teltrex pay in interest to Barclays over the 6-month period for the euro-dollar loan? So they're borrowing 3 million, all right? And they are getting it at LIBOR plus a lending margin of 0.75%. Okay? LIBOR is currently 5.3%. So how much are they paying? So basically, you're going to multiply your principal by the 5.53 plus the 0.75%. Okay? So that works out to be 3 million times 0.0553 plus 0.0075. Remember, it's 0.75%. All right, so that's where the zero. Okay, now remember the rates are annual rates, so you're going to have to divide it by 4. Okay? You remember when we did your options, forward to futures, you have to divide by 4.
Yes.
Okay?
I remember something like that.
So they're gonna pay this plus, because remember, they are rolling over. So they're doing it over a 6-month period. Okay? So now they have to add the other 6 months, which is your 3 million times what rate we're using here. The rate fell to what? 0.05125, and you're still adding on 75.75%. Okay? So you work out this piece first, then you work out this piece. And without looking in the book, what you got?
The first one I got
47,000. 100. You rounded.
No,
So that's what I got.
that's what I got.
Okay. 100. Uh-huh.
I'm working on it.
Okay. Let me see.
I got 4,000.
I got 47,109.38, like the book.
Miss, it's because they
The
have
rate.
0.553125.
125.
Oh, okay, because, okay. Okay,
I think that's what it is.
because you rounded when you did your 17 divided by 32.
Yeah.
Yeah, so this should be 1, 2, 5. Okay? So if you,
5.
yeah, when you don't round so early on in your transaction, you wait until you get down, right? Because Remember, dealing in the Eurobond market and we're dealing in millions of dollars. And every decimal point counts. So you only round it when you reach at the end. Okay? And then this is 44,020. Sorry. Not 020.
062.
62. 062.5. Okay? And so when you add those together, you get 91, 171.88. So that's the interest they pay on the euro credit, right? So it's really straightforward math, but I wanted to point out to you that back then they used the fractions. Now they don't use the fractions because if you look at the more up-to-date text, we use decimals. It uses the decimals. The point to remember here is that in the euro currency market, it's always LIBOR plus something or LIBOR minus something. All right? So you add the LIBOR plus 0.75% there. So that's a rollover euro credit. Huh? Because it's a 6 month, all right? Remember that it was a 3 month, it's a 3 month placement, okay? But then you're doing it over a 6 month period. And the rate they give you is an annual rate. So for the first 3 months, okay, this is the rate, but it's an annual rate, so you have to divide it by the 4 because it's only 3 months. And then for the second piece, remember the rate change, so that's why you have to separate it. So this is the rate, it's an annual rate, this plus the 0.75%, so you divide that by 4 as well, because it's a 3 month period. If it was a 1 year, then that would be different, you would divide by 4. But because it's 3 months, there are 4 3-month periods in a year, so you divide by that. Then you have your forward rate agreement, right? With the forward rate agreement, you are hedging, okay? So you that's not what I want to do. Okay, I lost my page. Okay, so the forward rate agreement is a hedge, all right? And what they're hedging is the interest rate risk, all right? So if you have, in the international banks, you have deposits, all right? And you have credit. So there's a rate on your deposit, there's a rate to pay in on credit. So in these markets, we're talking about a lot of volume, and the forward rate agreements that the banks have, they will need to cover them. So just like with a local bank, you take money, all right, and then you give loans. You will always have a mismatch in the interest payments, the interest you collect and the interest you give on your deposits. But then you have the mismatch of maturities, okay? You're familiar, those of you in 2076 and 2005 will be familiar with this, I hope. All right? you have your mismatch in your, where you have your rate sensitive assets and you have your rate sensitive liabilities, and they don't match, and so you end up with a gap, okay? What they're doing here is, because they're dealing with currencies, they're hedging, they're trying to cover that gap. And they cover that gap with a forward rate agreement. So you're finding the difference between your interest-bearing assets, your interest-bearing liabilities, and you try to cover that with a hedge, okay? Now, so if what you're paying is more than what you are receiving, what's going to happen there? If interest rates rise, if what you are paying is more than what you're receiving, and interest rates rise, what's going to happen to you? You're going to be losing money. All right, because when interest rates rise, what you're paying is going to be more. Okay? So you would be losing some money there, and so you want to cover the difference. So the forward rate agreement does that for banks, for international banks, right? So a forward rate agreement, by definition, is a contract that allows the Eurobank to hedge the interest rate risk, all right, in mismatched deposits and credits. So you have an instrument you can use for that, a forward rate agreement. So in the forward rate agreement, you're going to have a buyer. That buyer is going to agree to pay the person selling the agreement the interest costs on the amount. We will call it the gap, the difference between the deposits and your credits, right? If interest rates fall below a certain rate. Or the seller will agree to pay the buyer the increased interest rate if interest rates increase above the agreed rate. So that's how they're going to cover their business. And there's a formula for that. And I will tell you that, well, no, I shouldn't even tell you that. Never mind. No, I didn't put one on your exam, but you still need to know. Oh, that was a hard color to use for it.
Perhaps you need just a tissue paper. I needed a tissue paper, perhaps.
Yeah, and the solution that they use. All right. So remember, the forward rate agreement is going to be for a period, right? And so remember, there's a mismatch in the maturity of your deposit versus the maturity of your credit or your loan. And so you have to first calculate the, you have to know what the maturity is. So in the formula, all right, your payment amount of the FRA the formula for that is you need to know what principal you're working with, or the amount that you're working with, the amount they're trying to cover, and that's called a notional amount.
Notional amount that you need to cover.
Okay, and you're gonna we multiply that by it's actually, let me pull it up so that I don't have to write it. Well, I'll write it still, but let's put it here. Something's come back to haunt you, right?
What? There's a
I said something's come back to haunt you.
times this over 360 divided by 360 bracket.
All right. So days refer to the length of the forward rate agreement period. What do you think is SR? And what do you think is AR?
It's right there. Oh, that's it. Oh, sorry. My eyes.
So SR is
Settlement
the
rate.
settlement rate, okay?
Settlement rate. This is settlement.
And your AR is what?
Agreement.
Your agreement.
Explain what are we doing here?
Remember we said that in the forward rate agreement, you are going to agree on the rate at which you're going to make the payment. So you're looking for, you're gonna need, you will know what your agreement rate is. Your settlement rate is going to be what the rate is at the time, right? So in the example, so you have, this one is called a 3 against 6 forward rate agreement. What does 3 mean?
What does what mean?
This says a 3 against 6 forward rate agreement. Without reading through, what do you think that means? Make that bigger so you can see.
A 3 against 6.
So you have a 3-month Euro-dollar loan, all right? You're offsetting a 6-month deposit. So that's the 3 comes from the loan, 6 comes from the deposit, okay? And so the bank is afraid that the 3-month LIBOR will fall below the expected rate, and if it falls below that, then the euro credit is going to be rolled over at a lower rate. And so a 6-month deposit becomes unprofitable for them. Okay, remember, reinvestment risk and refinancing risk. One helps the other. All right, so the bank wants to hedge to protect itself. So they could sell a $3 million 3 against 6 forward rate agreement, and so the forward rate agreement will be, the way they're going to price it is such that they want to look at the expected 3 months dollar LIBOR rate. All right, so we're going to assume that the agreement rate is 6%. The actual number of days is 91 days because we're looking at 3 months, all right? So what is the bank going to receive? You fill in so the notional amount is 3 million, right? Your agreed rate was what? first call, you know what they're going to get. Okay? So it's your 3 million times 6%. Okay? And it's 3 months, so what we're gonna do, you're gonna multiply it by the actual days over 360. Okay? And so what you're gonna get there, that's the top part. Okay? What's your settlement rate? Settlement rate is 3-month LIBOR, which is 5.8%. All right, so we can actually fill that in right here.
Zero 0.05.
All right, so you working it out? Oh,
Okay, sorry.
stop taking pictures.
Okay.
It's in the book, you don't need to take a picture.
Okay.
This is just a little practice for you.
So it's in the book, but okay.
This practice equal to what? Like what? All right. Divided by what? What's this? 1 point something. 1.01. Okay, so that becomes okay, so we get 6550.59. No, it's negative, but in the FRA agreement, you use the absolute value. All right, absolute value meaning you remove the negative. Okay, so we're gonna take out the negative because you're using the absolute value. All right, so absolute value comes back to haunt you. Absolute value means what?
It's
There's
the
no negative.
negative.
Okay. So the it's really, and the euro credits, all right? It's simple interest rate, interest calculations, all right? And just remembering that because you're doing it short term, it's less than a year, so you have to multiply by 91 over 360, all right? And this is, so what that really says to you is that that is the amount that you are going to, that is the amount of your forward rate agreement, okay? So that should cover the expected decline in the in the money you're going to lose from the deposit, on the deposit rather. The other points in this chapter that we need to look at is how the different crises, that same Asian crisis and the Mexican peso crisis and now the global financial crisis of 2007 to 9, how those affected the international banking system. So that's what this really is about. And you had the credit crunch, which also went into that. So have a read of the chapter. I think this one, something. What I'll do, the readings, this gives you a little bit more information. My text gives you a little bit more up-to-date information. I will try to see how I can share that with you. The easiest way really is
Just
to
take the picture.
take the picture and
the
send
picture.
it.
Yeah.
Which is a lot of work.
Oh, okay.
Right, but I don't really take a picture of it because I don't think the library has this book either. So what I'll do, I will take the picture of the questions I want you to do and send it in the group. I'll do that now so that you have it. So these same questions are in your book, but it's in the fraction, okay? So I'll send, I'll take the pictures.
Okay.
All right, Jahim, come and take this picture and send it to me.
Good eyes.
I don't think my camera
Yeah.
don't like the quality coming there. So I want you to cover up here. So it's wonderful, but it's not sad. Or just edit the picture. All right, so Jahim is gonna send it in the group. All right? So that's for tutorials on Friday. Okay? And I've already posted the lecture notes for next week, so you can go ahead and read them. But I do know I gave you some work to do, so focus on the work first. but still do these for tutorial.
You know what you're asking?
I know the pressure coming to bear now, right?
Yes. Hold on.
A sign of the times, it's the end of the semester.
This is on right of the paper.
Exam. Huh? Oh yeah. The examination office hold us to some very tight deadlines. So yes. Yes. Huh? At least two of them. At least two. One of the number one and then the FRA. So number one, and I think that would be three.
Let's start with the study guide, please. Study guide for the exam.
Here, you were here last night.
Yes, but I really need it, miss, because everything is it's all over the place. So probably 2 weeks before the exam, at least. By Monday would be nice. Yes. That's probably. Miss, you can leave it. I'll erase it. I'll try and get a paper on. Yeah. Okay. Yeah, because, yeah.